Welcome to Project Option, everybody. My name is Chris, and in this video, we're going to talk about long call options versus long call spreads. So we're going to compare the two strategies and discuss the notable differences between buying call options and buying call spreads, and we're going to do that by using real examples with options on Facebook. Now, during those examples, we're going to talk about the pros and cons of long calls and long call spreads, and finally, we're going to talk about when to buy call options and when to buy call spreads based on the things that we talk about in the video. Now, the first topic we're going to cover when comparing these two strategies is the risk and reward. So let's compare the risk-reward potential when buying call options versus buying call spreads. Now, long calls have limited loss potential and virtually unlimited profit potential. And when you look at the risk profile graph of a long call option, the expiration payoff diagram will look something like this image that we're looking at right now. So on the bottom, we have the changes in the stock price, and on the y-axis or the vertical axis, we have the profitability of that strategy. So if the stock price is anywhere below the call's strike price at expiration, the strategy will lose the maximum amount, but if the stock price increases, there's no limit to the profitability of a long call strategy. Now, most aggressive directional traders love the long call strategy because of its limited loss potential and unlimited reward potential nature. So now we're going to hop over to the long call spread, and we're going to look at the expiration payoff diagram for the long call spread strategy, and we're going to look at any differences compared to the long call strategy. Now, similar to the long call option, a long call spread has limited loss potential. However, the profit potential is limited. Now, when you look at the expiration P&L diagram for a long call spread, you're going to see something with the following shape. Now, just like the long call position, at any price below the long call strike price at expiration, the long call spread will expire worthless, and therefore the maximum loss potential will be realized. Now, at any price above the short call strike price, we can see that the long call spread will realize the maximum profit potential, but unfortunately, the profit potential is going to be the same even if the stock price is $100 or $1 million above that short call strike price. So unlike that long call position, a long call spread has limited profit potential, which is realized if the stock price is above the short call's strike price at expiration. Now, be sure to keep watching because in just a second, we're going to go over some real-time examples of long calls and long call spreads using options on Facebook. Now, at this point, you might be wondering if both long calls and long call spreads have limited loss potential, but long call spreads have limited profit potential, why would anybody buy a call spread? Now, we're going to go over this in depth in just a moment with some real examples, but the short answer is that the premium collected from selling a call option against a long call option lowers the net premium paid, which reduces your overall loss potential. So if you look at buying a call and compare that strategy to selling a call against that call, since the premium paid is going to be lower for the call spread, the overall amount that you can lose on the position will be less when you look at that call spread compared to just buying that call. And the second reason, which kind of adds on to that first point there, is that the lower premium paid also reduces the break-even price of your position, which means the stock price does not have to increase as much for the strategy to break even. So when you buy a call option, compared to buying a call spread, the call option by itself is going to have a higher break-even price than that call spread, which means you need the stock price to increase by a more significant amount for your strategy to break even at expiration. So it's a lower probability trade to buy a call option as compared to buying a call spread. All right, so now that we've talked about the basic differences between buying call options and buying call spreads, let's go ahead and look at some real-time examples of both strategies and compare their risk-reward potential, directional exposure, time decay exposure, and exposure to changes in implied volatility. All right, so now that we've talked about the basic differences between the long call and long call spread strategies, let's go ahead and look at a real-time example of each strategy to talk about more specific topics related to each of them. So we're going to use Facebook for our examples today. So Facebook, as of now, is trading at $178.72 per share. So let's go ahead and look at some long call and long call spread examples in Facebook. So for this example, we're going to go to the expiration cycle with 67 days to go, and that's going to be the January 2018 expiration cycle. So for this example, we're going to use the at-the-money long call, and then we're also going to use that same strike and sell another call against it to create our call spread. So the closest strike price to the current Facebook stock price is going to be the strike price of $180. So to buy that call option, we're going to click on the asking price of $6.20, and we're going to lock that in. Now, to create our call spread, we need to sell a call against this 180 call. So we're going to buy that 180 call again, and then we're going to sell, in this case, the 190 call. So as we can see here, we have our single long call option, which is just buying the 180 call for $6.20. And we can see our call spread, which is buying the 180 call and selling the 190 call against it for a net debit of $3.69. So now that we have both of our trades queued up, let's go over to the risk profile analysis and look at the risk and reward potential of each strategy. All right, so now I'm at the risk profile page, and I'm looking at only this long call option, which is buying the 180 call that expires in January of 2018 on Facebook. So as you can see here, the entry price is $6.20. So let's start with the maximum loss potential. Now, when you buy a call option, the maximum amount that you can lose is the premium that you pay times $100 times the number of contracts. So in this case, we're only buying one contract, and since we're paying $6.20, our maximum loss potential is going to be $6.20 times $100, and that's because the standard equity option contract multiplier is $100. So $6.20 times 100 is $620. So as we can see here on the lower left-hand part of this chart, it says minus 620. Now that is the expiration P&L of this strategy based on the stock price that I'm hovering over. So as we can see here, at any price below $180, the loss at expiration will be $620, and that's because that 180 call will expire worthless, and since we paid $6.20 for it, we'll lose $6.20 per contract, which in actual P&L terms is a loss of $620. Now, in terms of profit potential, there is no limit to how much we can make on this trade, because if Facebook, blasts off and shoots to the moon, our call contract will rise in value with the increase in that stock price. Now, of course, it's not very likely for Facebook to, reach the prices that I'm looking at now, but it is one of the benefits of using a long call option to trade a very, very bullish assumption. So if you're aggressively bullish on Facebook and you think it's going to increase in price by a substantial amount, then the long call strategy is very beneficial to use because you have limited loss potential if you're wrong. But if you're right and Facebook explodes, then you have all of this profit potential to make. So now let's go ahead and look at the call spread portion. And really the call spread is just the same position. So it's the long 180 call, except we're selling another call at a higher strike price against it. So let's go ahead and cue that up. So as we can see here, we have a very different risk profile than we did with the long call option, and that's because the call spread has limited profit potential since we're selling a call against that long call. Now, one of the benefits of the call spread is that compared to just buying that call option, we have less loss potential. So as you can see here, just buying the call option would cost us $6.20 per call contract, but if we instead purchase the 180-190 call spread, our net debit is only $3.69. So similar to a call option, the most you can lose when you buy a call spread is the premium you pay times $100. So in this case, $3.69 times 100 is $369. And if we look at the risk profile, we can see that the loss at expiration, if Facebook is below 180, is going to be $369 per call spread. So if Facebook shoots up and is above 190 at expiration, then our maximum profit potential is going to be $631. But as we can see, if Facebook goes all the way to $300, our profit potential is still going to be $631. And if Facebook is at $191, our profit potential is still going to be $631. So really, when you're comparing a long call to a long call spread, the benefit of the long call option is that you have unlimited profit potential if the stock price increases. However, you do have more risk compared to buying that call option and then selling a call against it to create a call spread. So in this example, our long call can lose $620 per contract and has unlimited profit potential, but our call spread can only lose $369, but at the same time, it only has $631 of profit potential. Now, I didn't mention it, but the profit potential can be calculated by taking the width of the call spread and subtracting the debit from it. So in this case, we're selling the 190 call and buying the 180 call, which means our call spread width is $10. So 190 minus 180 is $10. And if we subtract $369 from that, we get $6.31. If we multiply that by 100, we get $631 of profit potential per call spread that we purchase. So while we have limited profit potential, our loss potential is much lower compared to just buying this call option. Now, the next thing we need to talk about is the break-even price of a long call versus the break-even price of a long call spread. Now, in both cases, you can calculate the break-even price by taking the long call strike price, which in our case is $180, and adding the net premium paid for the strategy. So we're going to start with the long call by itself. So the strike price again is $180, and to buy the 180 call expiring in January of 2018, we're paying $6.20. So that means our break even is 180 plus 620, which is $186.20. Now, as we can see here, right at 186.20, our break even is going to be, our P&L is going to be zero. So if Facebook is right at $186.20 at expiration in January of 2018, this 180 call is going to be worth $6.20, which is exactly what we paid for it, and therefore we won't make or lose any money on the trade. Now, as we can see here, since we're paying less money for this 180-190 call spread, our break even is going to be lower. So if we switch over to the call spread, we can see that the break even price is going to be 183.69. So we're taking the long call strike price of 180 and we're adding the debit paid of $3.69. So 183.69. So as we can see here, if we buy this call spread, our break-even price is lower, which means we don't need Facebook to increase as much for us to not make or lose any money on the trade. So when you're buying a call option, you need the stock price to increase more significantly just to get back all of your money on the trade or not lose any money, compared to buying a call option and selling a call against it. Now, the reasoning for that is when you buy a call spread, your debit paid is going to be less than if you just bought the call and didn't sell anything against it. So one of the benefits and one of the most attractive parts of buying call spreads instead of just the call is that your break-even price will be lower, which means there's a higher probability that you do not lose money on the trade. All right, so the next topic we're going to talk about is the delta exposure of the long call and long call spread strategies. So when we talk about delta exposure, we're talking about how much we're expecting to gain or lose if the stock price changes by $1. Now, the delta will change as the stock price changes dramatically. So for this example, we're just going to use plus or minus $1 as the expectation for how much we're going to make or lose. So right now, I only have the long 180 call selected. So as we can see here, the delta of the 180 call is positive 50. Now that means if the stock price increases by $1, we're expected to make $50 on the trade. And if Facebook decreases by $1, we're expected to lose $50 on this trade. Now, of course, that assumes that the movement happens today without any changes in time or implied volatility or any of the other inputs. So this is just direction. Now, when we look at the call spread, we can see that the delta is plus 23. So that's more than or less than half of the delta exposure of just owning this 180 call by itself. So that plus 23 delta means that if Facebook increases by $1, we're expected to make $23 on the call spread. And if Facebook falls by $1, we're expected to lose $23 on that call spread. Now, as you might guess, that means that the long call is more aggressive in terms of the directional outlook, and that's because its delta is higher. So when you just own this call, the delta as of now is plus 50, and if you instead buy the call spread, the delta will be plus 23. So in terms of direction, it's very clear that buying a call option is a much more aggressive strategy, and that stems from the fact that a long call option will have a higher delta value than buying a call spread. Now, another thing we're going to talk about is the change of that directional exposure. So as we can see here, this pink line actually gets more and more slopey as the stock price increases. So the slope increases. So that means that if Facebook increases, our delta exposure is expected to be higher than it is now. So right now the delta is plus 50, and if Facebook increases by $10, we can see that the delta exposure is expected to be plus 72. So that means if Facebook increases by $10 and then increases by another dollar, we're expected to make $72 from that additional $1 increase, but we're expected to lose $72 if it falls from that price. So in short, if you just own a call option, your directional exposure is going to get closer and closer to plus 100, which just means your position is going to get closer and closer to owning 100 shares of stock as the stock price increases. Now, as you can see here, it gets closer and closer to zero as the stock price decreases, and that just means that the further and further out of the money your option gets, the closer your position is going to be to owning 0 shares of stock. Now, if we go ahead and look at the long call spread, we can see that the delta actually starts to taper off as the stock price increases. So as of right now, with the stock price right around its current price, our delta is plus 23. But as we can see here, if the stock price increases to, let's say, $210, then our delta exposure is expected to only be plus 7. So that means if the stock price were to jump to $210 today, then our delta exposure for this call spread would expect it to be only plus 7. So that means if the stock price increased by another dollar, we would only be expecting to make $7. And if the stock price fell by $1, we would only lose $7. So that's one difference between long calls and long call spreads, is that as the stock price increases, a long call position will get more and more bullish because the delta will approach plus 100. And in terms of the call spread, the further the stock price increases, the closer and closer your call spread's delta will get to 0. So that's one huge difference in terms of directionality when comparing calls and long call spreads. Now, the next thing we're going to talk about is time decay as it relates to owning call options and owning call spreads. Now, time decay or theta decay refers to the profit or loss exposure from the passage of time as the extrinsic value in an option position decreases as those options approach expiration. So, in the case of this long call option, the long 180 call expiring in January of 2018, we know that if Facebook is below 180, then this 180 call option is going to expire worthless. So right now it's worth $6.20, and all of that value is extrinsic value. Now, when an option expires, it has no more extrinsic value remaining, as all of its value will be intrinsic value. Now, that means that if Facebook remains right at its current price, which is below $180, we know this $6.20 option will approach $0 as time passes. So time decay refers to how much this option is losing on a daily basis as its extrinsic value approaches 0. So let's go ahead and look at the theta or time decay exposure of this long call option that's expiring in 67 days in January of 2018. So as we can see here, with the stock price at the current price, our theta exposure is minus 5. Now, that means that with each passing day, we're expected to lose $5 on this long call position. And that just means that, as this extrinsic value of this option is decreasing with every passing day, we're going to lose money because the option price will be decreasing. So if we just buy this 180 call, our theta exposure is minus 5, which means we're expected to lose $5 with each passing day. Now, if we switch over to the call spread, let's go ahead and look at the theta decay exposure of that call spread. So right away, we can see that the theta decay or time decay exposure of this 180-190 call spread is only minus 114. Now, that means with each passing day, we're only expected to lose $1.14 on the position, which is much lower than the minus 5 theta that we're experiencing on that long 180 call. So when you compare the time decay exposure of a call to a call spread, the long call by itself is going to have more exposure or more loss potential from the passage of time relative to that call spread. Now that's because not only do we own this 180 call, but we also sold a 190 call against it. Now as time passes, both of these call options are going to lose value since they are both out of the money. So at expiration, if Facebook is below 180, this long 180 call is going to expire worthless, and this 190 call will also expire worthless. So the benefit of the call spread is that since we shorted this 190 call, the profits from that call expiring worthless will offset the losses from owning this 180 call. So as time passes, both of these options will decrease in value, except with the call spread, since we shorted this 190 call, the decrease of this 190 call over time is going to actually generate profits for us, which will offset the losses from the time decay of this long 180 call. And that's how we get that minus 114 theta. So when you compare a long call to a long call spread, the call spread will have less exposure to time decay because you have a short option that is decaying in favor of your portfolio, which is going to offset the losses from the time decay of that long option. All right, so the last topic we need to talk about is each strategy's exposure to changes in implied volatility. Now, a change in implied volatility simply refers to an increase or decrease in the amount of extrinsic value that exists in a stock's options. So, for example, if you had a $100 stock with 20% implied volatility and a different $100 stock with 30% implied volatility, the $100 stock with 30% implied volatility would have more expensive options and therefore more extrinsic value in those options compared to the $100 stock with 20% implied volatility. So when we're talking about changes in implied volatility, we're basically talking about overall changes in the prices of options on that stock. So when you own a call option, you have positive vega exposure, which means you have a positive exposure to changes in implied volatility. So in other words, if implied volatility increases, you are expected to make money from that increase in implied volatility or extrinsic value, which makes sense because if you own an option outright, you want its price to increase as much as possible. Now, if that price increase comes as a result of an increase in implied volatility, which just means that people are buying up those options and they are becoming more expensive and have more extrinsic value, then that means your call option is going to increase in value, which is going to yield profits for you. So on this risk profile graph, we're looking at two implied volatility environments. The first one is a 20.38% implied volatility, which is simply Facebook's current implied volatility reading. And the second line we're looking at is 30.38% implied volatility, which is just a 10% increase from Facebook's current implied volatility. Now, when we look at these P&L readings, you can see that the higher implied volatility is going to give us more profits compared to the lower implied volatility reading, and that's just because it is showing us Facebook's, or it's showing us that options price with that added extrinsic value. So at 30% implied volatility, the options on Facebook will have more extrinsic value than they will if Facebook had its current implied volatility of 20%. So if we had an increase in Facebook stock price with an increase in implied volatility, we can see that the P&L expectation is going to be higher with the increase in implied volatility relative to that same stock price change with no change in implied volatility. Now, on the other hand, if implied volatility decreases and if implied volatility increases as Facebook decreases, as we're looking at right now, then the increase in implied volatility will offset the losses from that adverse directional movement in the stock price. So, for example, if Facebook fell to $170, if implied volatility did not change and remained at 20.37%, then our loss would be expected to be around a loss of $353. And if implied volatility were to increase by 10 percentage points with that same decrease in the stock price, then our P&L is expected to only be negative 87 as opposed to negative 353. So when you buy a call option by itself, an increase in implied volatility is going to help you in terms of profits when the stock price increases and is going to offset your losses if the stock price decreases. So now let's do the same analysis with the long 180-190 call spread in January of 2018 on Facebook. So let's click over to the call spread and look at this risk profile with these two different implied volatility readings. Now, as you can initially just observe from this chart, the two lines actually have a crossing point as opposed to, when we're just looking at this long call option, the higher implied volatility line is higher than that lower implied volatility line at basically every single price. Now, when we're looking at the call spread, we can see that the higher implied volatility line is higher than that lower implied volatility line when the stock price decreases, but when the stock price increases, that lower implied volatility line is actually more profitable than that higher implied volatility line. So what does that really mean? Well, that means if we buy a call spread and the stock price decreases, an increase in implied volatility is actually going to be beneficial for our position, because that increase in implied volatility is going to offset some of the directional losses that we're going to experience from this positive delta strategy of buying a call spread. Now, on the other hand, if the stock price increases, then an increase in implied volatility is actually going to be harmful to our position. So when you buy a call spread, you want the stock price to increase and you want implied volatility to either remain the same or decrease from its current value, because when you buy a call spread, you can only realize your maximum profit potential if all extrinsic value in the options goes away. Now, that basically means that if you buy a call spread, in an ideal scenario, you'd have the stock price increase to a price above your short call strike price, and in this case, that's going to be $190, and you're going to want implied volatility to decrease, because if the stock price is above your call spread and your call spread is fully in the money, then you want all of the extrinsic value of those options to come out of the position, as that will allow you to achieve maximum profit potential. So just to verify that for you, I'm going to take the current implied volatility and we're going to look at the P&L expectation of this position if implied volatility went to zero. Now, if implied volatility goes to zero, that means Facebook's options have absolutely no extrinsic value remaining. So I'm going to go up here and I'm going to do negative 20.35%. And as we can see, we're looking at basically the expiration payoff graph of this call spread. So if Facebook were to go to $190 and implied volatility went to essentially zero, then our profit would be right around $630, which is the maximum profit potential of this call spread. Now, more specifically, the maximum profit potential of this call spread is $631, but this chart says $629 because I only subtracted 20.35% from 20.38%, so it's not exactly zero. Now, we just covered a ton of content, so to quickly summarize, long calls are more aggressive directionally and have more risk compared to long call spreads that use the same long option. And to follow that up, long calls have more exposure to losses from time decay compared to long call spreads, as the decay of the short option in the spread offsets losses from the decay of the long option. Now, in regards to exposure to implied volatility, long calls benefit from increases in implied volatility no matter what happens with the stock price. Now, on the other hand, long call spreads benefit from increases in implied volatility when the stock price decreases. And as the stock price increases, long call spreads actually benefit more and more from decreases in implied volatility. So if that stock price is moving through your call spread strikes, a decrease in implied volatility will actually help your position profit more and more. So now that you have a firm understanding of buying a call option versus buying a call spread, when should you buy a call and when should you buy a call spread? Since you've learned that a long call by itself is much more aggressive in a directional sense compared to buying a call spread, then a long call position is suitable when you are extremely optimistic about the stock price in the future. So if you're expecting a significant increase in the stock price in the future, then buying a call option has more profit potential for you than buying a call spread. Now, when it comes to call spreads are great to use when you're not as bullish or when you simply want to reduce the loss potential and time decay exposure of the position. So some traders simply do not like to have all of that negative time decay exposure and don't like having such a high break-even price, so they'll opt for a call spread as opposed to buying a call option outright. So it kind of comes down to personal preference and what your overall outlook for the stock price is that will help you determine when to buy a call option by itself or when to buy a call spread as opposed to just that call option. Well, that wraps up this video on call options and call spreads. I hope you enjoyed it and found it to be very valuable. If you did, please go ahead and give this video a like, Subscribe to our YouTube channel so you can get all of our videos in the future. And since we covered so much content, please feel free to drop a comment down below if you have any questions.